In Chapter 1, what we do is start with the end product, and then we explain in the rest of the chapters how the information gets on the end product, which we call the financial statements. So what I'm going to do is do an overview of the 4 financial statements that are required by generally accepted accounting principles, also known as GAAP. Now, the 4 financials that you need to know how to prepare, hopefully by the end of the semester, are the income statement, the statement of stockholders' equity, the balance sheet, and the statement of cash flow. Now, I'm going to walk you through each one of these, but let me explain the flow first of the information. Now, we start by preparing the income statement. This includes all revenue and expense accounts. Those are the only accounts that are included on the income statement. Please remember that. This information then flows into the statement of stockholders' equity. This is going to show changes in stock, dividends, and includes net income. So now what we've done is we've rolled the information from the income statement into the statement of stockholders' equity. We will then use these ending balances from the statement of stockholders' equity to then prepare the balance sheet. The balance sheet shows the accounting formula by listing assets equals liabilities plus stockholders' equity. And then the last statement we prepare, because we need the income statement and the balance sheet, is the cash flow statement. Now, what that does is explains the changes in the cash balance from the beginning of the year. So now what I'm going to do is walk you through the 4 statements and give you an example to work with. First of all, the income statement is the difference between revenue and expenses only for the current year. Remember, we always look at net income for the current year. No other accounts appear on this statement, remember that. So revenue minus expenses gives net income. So now what we're going to do is we're going to look at an example, and this is the kind of information you're normally provided. This would be considered a adjusted trial balance. What it does is it gives you the balances, the ending balances in your accounts at year end, and it also provides additional information that you would need in order to do the financial statements. For instance, it tells you they had issued $10,000 in stock during the year, which means that the common stock of $42,000 includes that $10,000, so the beginning balance would have been $32,000. So when we do the income statement, the first thing we always list are the revenues. So here's another thing that's very key whenever you're doing the financial statements. When you're looking at a list of all the accounts, what you need to do is check them off as you use them, because you only use them once. So we start with our revenue, and now what we're going to do is look at our expenses. And so the first we start with is cost of goods sold. It's one of the few accounts that doesn't have expense in the title. However, it is an expense because it's all costs associated with producing a product that you're selling, and usually transfers from what we call our inventory account. Inventory are products that we've purchased for resale. When we sell them, those costs transfer from inventory to cost of goods sold. So normally when we do expenses, we start with the highest to the lowest. So we would start with cost of goods sold, then we would list rent expense, and then we would do salary expense. Now we've checked those off. Again, we're not going to use them again. So we then list. Now what we've done here is a subtotal. So we can see the individual expenses, and then we can see our total expenses. We always subtract expenses from revenue. Please remember that. I have seen many examples of people trying to add these together. You don't do that. You subtract them. So now we have net income of $66,000, which we will then transfer to our next statement, the statement of stockholders' equity. Now, what's the formula? What we would do is first get our beginning balances for common stock retained earnings, and that would give us total stockholders' equity. Remember, retained earnings are prior year profits or losses less any dividends. Net income and dividends only reflect current year activity. Please remember that. Stock issues plus net income minus dividends give us the ending balances, and this is what we're going to use on the balance sheet. So now let's go back to our example and take a look at what this means. So, ABC Company, what we want to do is we start with, now we've got to find our beginning balances. So, we're going to look at our common stock, and we know we have to adjust it by 10,000 to come up with our beginning balance. And then we're going to check off our retained earnings and our stockholders' equity when we total them across. Now, we're going to add to that the stock we know we issued plus the net income that we got from the income statement. Then we're going to subtract the dividends, because dividends reduce retained earnings, because these are distribution to stockholders. Now we have our new balances. These are what we're going to use on the balance sheet. So remember, it's the ending balances that appear on the balance sheet. And what we've really done is rolled up all the detail associated with net income and stockholders' equity and incorporated them into final numbers. Now we're going to go to the balance sheet. The balance sheet, it's going to list all of your assets, and then it's going to list your liabilities and equity, and these have to always equal. Otherwise, you've done something wrong. So let's go back to our example. Now what we have to do is find first our assets. Now usually they're based on liquidity. How quickly can they be converted to cash? So we would start, of course, with the cash. Then we would look at inventory, because that's more liquid, because usually we want to turn that pretty quickly. And then our long term would be equipment. The next thing we would look at is our debt. And again, those we would look at based on how quickly we have to pay them. So we'd start with accounts payable, and then we would show our long-term debt. Now you notice I now have checked off everything on that list. So here's what we end up looking at. First of all, we would list our cash, inventory, and equipment. We get total assets of $191, and then we look at our liabilities. We list those first based on when they have to be paid. We then take the information from our statement of stockholders' equity, plug that in, and if you notice, we equal. So, to get stockholders' equity, make sure you take the ending balances, because you will not balance if you don't do that. Now let's go through a little test again to see, do we remember where these things go? So, we know what type of account they are. Now what we need to know is where they would appear on the financial statements. So remember, if it says supplies, it's an asset. If it says supplies expense, it means we've consumed them, which means it's an expense. So we have supplies, that would appear on the balance sheet because it's an asset. Notes receivable is an asset, balance sheet. Service revenue is revenue, income statement. Dividends are going to be on the statement of stockholders' equity. Accounts payable is going to be on the balance sheet. Cost of goods sold, which is an expense, is going to appear on the income statement. Capital stock is equity, so it's going to appear on the statement of stockholders' equity and the balance sheet. Accounts receivable is going to be on the balance sheet because it's an asset, along with the equipment. And supplies expense, because it's an expense, is going to be on the income statement. Now we're going to look at our last financial statement, which we go into more detail in our last chapter. The statement of cash flow. The reason we cover this last, or toward the end of the semester, is because you cannot do it until you understand how you do the income statement, the statement of stockholders' equity, and the balance sheet. And you have to be able to prepare all those first, because only then can you prepare the statement of cash flow. And on the statement of cash flow, what we're trying to do is we're going to look at the beginning cash and the ending cash, and we're going to explain the difference. And that difference is going to be broken down into 3 areas. Income from operating activities, those are from ongoing business. Investing activities, this is when we buy or sell long-term assets. And financing activity, how did we fund the company during the year? Did we issue stock? Did we borrow money? Did we pay money back? Did we pay out dividends? So now let's take a look at an example. So we have a company. This is their cash inflows. This is their outflows. So the first thing we're going to do is cash flow from operating activities. First of all, customer payments would be part, again, of operating activities. And also, we would include employee salaries and supplies, which the employee salaries and supplies would reduce the cash flow and the customer payments would increase it. So we have generated cash from operating activity, which is where you want to generate the cash, of $34,000. Now let's look at investing activity. We're going to look at buying or selling any long-term assets. So first we have the sale of our equipment. And then we have the purchase of a building, which would reduce our cash. So we have reduced our cash based on investing activities. Now this is not a bad thing because buying a building means that we're looking forward. Now the last thing we're going to look at is how did we finance the company's growth. First of all, we borrowed money from the bank, but we paid dividends, which would have reduced our cash flow. So overall, this company has a negative cash flow from overall, which means that our cash went down by $6,500 in total based on activity from operations, investing, and financing activity. Now, whether this is good or bad has a lot to do with where the company is in their cycle. Are they at the beginning? Are they in the middle? Or are they at the end? Now, in summary, what we're trying to do is make sure we can understand that accounting is identifying, recording, and communicating financial information through the financial statements. That we remember that assets must always equal liabilities plus stockholders' equity. And GAAP requires that you prepare 4 statements. And that ends Chapter 1. I hope this helped you understand the overall concepts.